So welcome everyone to our, night webinar. We haven't done one of these for quite a while at night, mainly during the day, but thought everyone's probably, outside or back in the office or back on the building sites now that we're actually releasing the restrictions. So I thought it was probably a good one to do at night. So my name's Shannon Smith. I actually think I know most people that have joined us. There's only a few new names, and so hi everyone, Shannon Smith. Today I will be also joined by Paul and Jackie, and I'll go through that in just a second. But we want to talk today about property subdivisions and kind of some of the ATO Need-To-Knows, because it is something that we see coming up quite a bit regularly. So if you can move on to the next slide for me. Thanks, Paul. So just to introduce Paul Cunningham, an associate at Smart Business Solutions, and myself, Shannon Smith, and then we have a guest speaker later in the towards the very end. Jackie Prosser is going to give us some insight as well. So moving on to the agenda. So today, what we want to go through, and we've had a lot of clients going through various different, I guess you could say, subdivisions. I think we quite enjoy these types of projects that clients have going on, so maybe we help encourage them. But we have seen a lot of different issues going on, and it's a really hot area of focus from the ATO. There's a lot of cases going on, a lot of audits as well. So we want to go through today revenue or capital account and what that means. So when we've got a business of property development, profit-making undertakings, or whether we've just got a sale of property. I want to go through also the capital gains tax issues and what some of those points might be around subdividing land, pre-capital gains tax issues, and we'll go through that, and then main residence exemption. And then lastly, we want to go through GST issues, so whether you need to register or not, the margin scheme and the GST holding. Now, going through some of these areas on the subdivision and what's really triggered, I guess, our webinar tonight and things that we've seen over the last probably 18 months to 2 years. The ATO, as I said, have taken a really hot focus in this area. And over the past, I would want to say 18 months, we've had a lot of new clients to us that have come in that are under ATO review. We've had many that have come in that have been kind of not happy with how it was being dealt with, maybe with their existing accountant, maybe not having the skill set in those areas. So Paul is definitely the go-to person on whether it be we've gone through a lot of ATO negotiations in these areas, and also ATO full-blown audits where they've gone down to the absolute detail, and we've been trying to defend the client's situation. And a lot of it comes down to these three key areas, and quite frequently we see these issues coming up after the situation has gone about. So what we really wanted to highlight today is to go through these areas and for you to be aware of when should you actually be reaching out and having a chat before you go down that path, so you don't have any surprises going afterwards. So I'm going to hand you over to the absolute expert in everything to do with property subdivisions. Don't you love that, Paul? But no, Paul has done so many of these with the ATO, and there's a lot of intricacies. So handing it over to you then. Thanks, Paul.
Thanks, Shannon. So I guess just recapping a little bit of what Shannon said, I think the number one point hopefully that we can get across today is that you need to get in contact with your accountant, hopefully us, as early as possible in when you're planning these subdivisions, because there are key questions here that can change the outcome and your after-tax profit, depending on the way you're going to tax, the way you're going to be taxed. And the law generally, we're talking about obviously subdivisions and property, so we're talking about high value mixed with some reasonably complex tax law here. So it is really important to reach out to us as soon as possible to have a chat about what path you're going to go down. So the number one thing to start off with is basically, are you going to be taxed under revenue or capital? So to simplify that as best I possibly can, so capital would be your normal CGT, which I think most people should be familiar with. It's just that mere realization of a capital asset. So you bought an asset. It can be a property, it can be shares. You hold on to it for a while, maybe it appreciates a little bit in value, and then you sell it a little bit later. That's being accounted for on capital. That means we go into the CGT space, so capital gains tax, and we get access to a lot of discounts. So quite often we see that people want to be in this space if at all possible, because you've got a lot of discounts. You're most likely not going to need to register for GST as well. So it's a lot simpler if you can get into this space, but not necessarily as easy as some people would like to think. So the other option potentially is that you're going to be, or the other potential option is that you'll be accounting for it on revenue. So when we say revenue, we're basically saying this is going to be treated as if it was business revenue. So as if you're a business selling clothes, socks, whatever it is, you're just in the business of selling subdivided property. So we'll go through in a little bit more detail very shortly about how to determine whether you are in revenue or capital. Just because you don't think, well, it's not my day job, I'm not subdividing property and selling every day and building on it every day, so I shouldn't be in business. That doesn't necessarily mean that isn't necessarily the case, and more people would be on revenue than would account than they would actually think that. So why does it matter? It matters because of the items that I've just talked about. CGT discount. If you're on revenue account, you're not going to get any CGT discount. So CGT discount, the most obvious one is if you hold it for 12 months, you get a 50% discount on any gain you make. That doesn't happen on revenue account. Main residence exemption doesn't happen on revenue account. Also important, pre-CGT assets. So if you're thinking of subdividing property that or land that you purchased or acquired before the 20th of September 1985, I know that's a while ago now, but if you are lucky enough to be holding onto a pre-CGT asset, then that's something you definitely need to come and talk to us first, because you might trigger that asset to become a CGT asset by subdividing in certain circumstances. Again, capital losses, you won't be able to use capital losses to offset your capital gains if you're on revenue account. CGT concessions, again, similar. GST, more likely than not, you will be needing to register for GST and pay GST on your property sale if you are on revenue accounts. It also affects the timing when you include it in your tax return, and it also affects your deductions, mostly where you can claim and how you can claim your deductions. So we'll go through that in more detail, but it is really important. That's why we do stress that you need to get to us early on in the piece to have a look through and to talk through how you're going to be taxed. So the example I've got for you here, and this is not an example to decipher whether you're on revenue or capital. This is an example to show how big the difference can be. So Mary bought land for $100,000 in 2016. She subdivided the land and sold the lots for $250,000 in 2019 and incurred subdivision costs of $50,000. So on the next page, we have the total difference, the after-tax profit, the difference between capital and revenue account. So if we go through just briefly, so on capital account, we can see across both lines, we've made a $100,000 gross gain. But on capital account, we've been able to apply that CGT discount because we held it for more than 12 months. So the net taxable gain is $50,000. It's on capital account, so we have been able to ignore GST. We're not falling into the GST system, so there's no GST there. We're going to assume that Mary is in the highest income tax bracket of 47%. So we can see that the after-tax profit, if on capital account, is $75,500. That's extremely different, as you can see, to if it was on revenue account, where you have no capital gain discount, no CGT discount, so your net gain is $100, $1,000. You are losing you're losing 1/11 of the sale price of the subdivided land on the GST liability. Now that we've assumed there's no margin scheme, which I will come back to in detail later, and I'll just loop back in a second. And then we've got the income tax profit of 47%. So a big difference there. On a $100,000 profit, we've lost an extra $35,000 essentially. So the margin scheme is one example why we really need to know early what your plans are and need to make these assessments, because if you are going to be on revenue account, then you want to get into the margin scheme if at all possible. So that's something that we need to do at contract date. So we'll go through that in more detail later on, how that works. But the margin scheme is really important to get into if we can. So the types of there are three possibilities for the way this can be taxed. We've been talking about CGT, so that's the mere realisation of a capital asset. That's often the place that we want to be in. The other possibility is if we are in the business of property development. So this is basically where the ATO will consider you as a business. So basically, this is there are a number of factors that can be built into how this is determined, but profit-making intention is probably one of the big ones there. So if you're buying an asset with the intention of turning it around in a reasonably short space of time, you're buying it to make a profit, then there's a high chance that you're in the business of property development. The third possibility that's often forgotten about a little bit is the profit-making undertaking. So this is where, this is essentially very similar to the business of property development. It is on revenue account. You are being taxed on revenue account. There are just some slight differences between being in a business and being on a profit-making undertaking. The profit-making undertaking, generally you fall into this rule if you're not doing it repetitively, so you're not doing it more than once, and you're probably not going into too much detail and doing too much work in it, so you're not necessarily quite considered a business, but you have that profit-making intention. So therefore, you can't just call it a mere realisation of a capital asset. The ATO approach to determining how you fit into those three spheres, they want to consider all the surrounding factors and circumstances. Some factors carry more weight than others, but importantly, there is no weighting factor, if you like. You can't just simply tally up the points and go in a certain direction. So you need to take the whole case as an example and consider it as a whole. One thing that is really important is the intent. Quite often, a lot of these things you'll see on the next page, the fact is we're looking at the intent of the taxpayer. And the taxpayer, and that intent has to be determined objectively. So we've been recently through an ATO audit for a client that we inherited who was in an ATO audit when they came across, and we had to provide evidence of intent. So they were saying that they were always planning to hold this particular asset for a long term. So we had to provide evidence for that. Unfortunately, we were able to provide evidence for that, but we had to have written evidence, dated evidence that dated back to basically when they purchased it to prove that evidence. We can't just say 3 years later, oh yeah, we always intended to do this. So key factors, and this is a big list, and it's by no means an exhaustive list. So there are a lot more factors on the ATO list, and the ATO actually notes that these factors can change over time as well. So there is no set guidelines, but these are the kind of things that factor into whether you're going to be in the business or whether you're going to be taxed on revenue or whether you're going to be taxed on capital account. So one of the big ones obviously is intention when the property is acquired. So if you buy a property and you hold on to it for a reasonable period of time, maybe you rent it out for a while or something like that, then you're more likely to be in the capital space, the CGT space. If it's a short term, you acquire it, you subdivide it straight away, and then you flip it, to a year or two later, then yes, then you're probably more likely to be in the revenue space. I'm just going to pick out a few of these. I'm not going to go through every single one, but the location of the land is also considered. So if you're buying land in a location that the ATO deems as high likelihood that you're going to make a profit by subdividing, so that they can even look at that. Previous attempts to sell. So if you've had attempts to sell a bigger block and haven't had much luck in getting interest in that, and an agent or somebody else says to you, how about you subdivide, that may help you sell off the property or the land. That can actually work in your favour for a CGT and pushing into CGT space, because it goes back to sort of showing that intention of what you're trying to do. You're just trying to capitalise on the asset rather than making the subdividing to make a profit. The cost of the development, how much money are you spending, how much time, and not only money, but also time and effort are you spending into arranging the subdivision. This can also come into play about whether you're in a business or whether you're just really realising the mere realisation of a capital asset. If you're just realising a capital asset, then you're probably not putting too much work involved, is basically the ATO's point of view here. The more work, the more money you're putting in, the more risk to you as the investor, the more likely that this is a profit-making undertaking. Another big one here is the final one that I want to point out is the history, and that's your history as a taxpayer. It also looks at your related parties, related entities. So if you have a history of subdividing land, then more likely than not, you're going to be in the business space, not the capital gain space. And they will look to trusts that you own, your parents, your brothers, your sisters, that sort of thing, to get the history of how is this all happening. So that's another. So if you're doing this repetitively and just in different entities, that's probably not going to help you, and they will catch you because they will do the ATO data matching is very, very high quality, as I'm sure Shannon would agree. So I'll just take a sip. So the mere realization of a capital asset. So if we fall into this space, so we're using the CGT rule. So we've got options there for a lot of CGT discounts, the 50% discount if we've held over 12 months, potential main residence exemptions, potential small business CGT exemptions as well. So it's a really good space to be in for that aspect. Holding costs. If you've got holding costs, say for interest on borrowed funds while you're holding the land, that in most cases can be added to the cost base, but it can't be deducted as you go. In terms of the timing rules, apart from a few carve-outs, like if it's purchased from a related party, generally you're putting this in your tax return in the year that the contract was entered into. If we're in the business of property development, then that means our land is now being treated as trading stock. So we fall under the same trading stock rules as any other business that's holding trading stock, whether it be clothes, food, whatever it is. So we're valuing closing stock at the end of the year, and we've got a few options about how we can do that. Our holding costs, so again, like interest, these can be now deducted as we go. So we can deduct it each year as we go along because we're now in business. So these are just the general costs of being in business. The timing rule here is that the sale of property is recognised at settlement rather than at contract date. So it's a big difference between the capital event. Profit-making undertaking. Again, as discussed, very, very similar to the business of property development. It's not going to be classified as trading stock, so you wouldn't necessarily record it on a balance sheet, but you're going to be taxed on the net profit. So basically your sales less the cost of purchasing, owning, developing and holding the property. Again, your holding costs are going to be, holding costs in this case will be added to your cost base and will reduce the amount of income on the sale of the property rather than being deducted in your return as you go. So that's probably the main difference between profit-making undertaking and the business of property development. Again, the timing rules, it is recognised at settlement. I think that's it for me for the moment. Shannon, I'll hand over to you.
Okay. Let's go through. So now just to touch on, and Paul's talked about on a revenue account and then on capital account. Now I'm just going to go through a few aspects on a capital gain side. So as Paul mentioned, capital gains, generally, if we're doing anything with property, and usually because it's large sums of money, a lot of us would love to actually have it on capital account because that's when we achieve some of those discounts that Paul was talking about, maybe the 50% discount. There can be even other small business concessions and other aspects that can come into that as well. So when we're talking about if we've got a capital asset, so let's say you've had a property and now you've decided, and it's been on capital account, you've been doing a rental and it's just been as a capital asset, and now you've contributed to a profit-making undertaking. So you've had an asset, maybe it's had an old house on it, you've been renting it for many years, and now you've decided, well, I'm actually going to make this a profit-making exercise. I'm not just, as Paul mentioned, that mere realization. I'm not just selling, realizing the asset by selling it. I've decided to make a profit-making undertaking. I'm going to subdivide it. I'm going to put 2 units on it and I'm going to sell it. So what do we do at that stage? Because we've got a capital asset, but you've now become, in a sense, a bit on a revenue account, so profit-making undertaking. When we're looking at that calculation, and this is trying to simplify the calculation as much as possible, but to try and kind of highlight the different aspects that you have when we are talking on this capital account and revenue account, is you're looking at the net profit calculation based on the market value of the property at the time that it was contributed to the project. So basically you're looking and saying, okay, at the time that we started this profit-making undertaking, what was the market value of the property at that time? You're then going to, and then you're actually from that, that's going to become, I guess you could say, the base as far as calculating what was your profit on what we call revenue account. So if you ultimately did the development and say sold it for $1,000, and at the time that you started the development, the property was worth say $400, and you did $300 worth of development costs, then the market value was $400, even though you may have paid $100 for it. It was $400 plus the $300 development costs. So you've had, so basically it's $700,000 is literally the expenses side or the cost part of this, then selling for a profit-making exercise of $1 million. That would be $300,000 would be taxable in a sense on what we call revenue account, but we still then actually have to do a capital gains calculation on the value of the fact that the property was 100, you in a sense now for that part of it sold it for 400 because that was the market value at that date. But at least when you do the capital value at that time, you do get some of those discounts. So we do the profit calculation on what you've made, then we have to do the capital gains tax on that aspect, and to make sure that overall you are being taxed on the whole amount, but you are actually being able to achieve some of that on capital account, not just on revenue account. So you can see how some of these calculations can be really important to know up front when you're going into it, because if we are changing a capital asset into a profit-making exercise, we're going to be actually getting you to get a market valuation at that point in time, rather than trying to get one at a later point in time and having some of those discussions at that point. So if you want to go on to the next slide there, Paul. Okay, then the next one can also be where you might actually have, your screen's come up, there you go, capital asset may become trading stock. And as Paul mentioned earlier, trading stock can be where you're actually in the business in a sense of doing these types of development, so a property development type business, but you may have had a capital asset that has now become trading stock, and it's kind of like a notional purchase, which is going to go in a sense from your balance sheet as a capital asset, but it's now come part of this trading stock, and it will be either at cost. And if you did that at cost, you could do it at cost and move it in a sense from a capital base to revenue at cost, or you can do it at market value. Now, there can be a really big difference on what you do here, and Paul will talk about also then the GST later and how that impacts. But the big difference here is going to be if you do it at cost, there's no capital gain like I talked about in the earlier example. So there's no potential 50% discount. There's none of that incentive. So really, when you're moving from becoming to trading stock, we're often trying to do it at market value to try and get part of that capital gain in a sense up front. Now, the only reason, so if you did do it at market value, and let's just say it was going to be a 3-year development, if you did it at market value today, because starting tomorrow, you're starting this development, but the development's going to take you 3 years, you will actually have to pay tax on the capital gain in the year that you've now triggered this capital gain, but you're actually not going to get the revenue from the development for say 3 years. So often with this situation, we might be going back and forth with clients on it. We'll be saying, look, capital gains is the really best way to go here because this is how much tax we can save you. However, if they don't have the cash because they're putting all the money into the development, they're waiting for some of it to be sold, they may actually choose to do it on revenue account just because of the cash flow. So this one can be a really big balancing act. We'll often even maybe involve their bank as well on this one to try and work out, is there any way that we can help get funding in a sense to pay that capital gains that we're going to be paying now so that we can get cheaper tax overall for the whole overall development. So do you want to go to the next slide for me, Paul? So just as an example, and this is a really common example, just to highlight some of the issues that we have on a capital gains. We see this one quite a bit. Two friends acquire some land, 600,000 as tenants in common. So basically it just means two individual owners, they maybe two friends that say, hey, let's go halves in this land. And what we're going to do, we're going to build two townhouses. And at the end of it, you can have one townhouse and you can live in it or do whatever you want to do. I'll have one townhouse and we're all, we're all happy. We've got our house each. So each person will take the ownership of the townhouses at the end, and it may be used as their main residence. Now, interesting on this one, a lot of people don't realise that this will actually be subject to capital gains tax in this situation, because what you've actually got is a situation where you both own 50% of each townhouse. So when you say you have townhouse A and I'll take townhouse B, I'm giving up half of townhouse A and buying half of townhouse B. Now, the buying is not an issue on your side, but when you're selling half your share, you're going to have a capital gains tax consequence on that as well. So that's something to think about as well. Do you want to go on to the next one for me, Paul? So when you're looking at the subdivisions and you're going through that process, you need to be looking and thinking about, is there a capital gains tax event when you're going through the subdivision? Now, one thing to actually point out, that a subdivision of the land itself does not necessarily trigger a capital gains tax event. So if you own that land and you subdivide it, that does not mean that's not the capital gains tax event at that point. It's when the ownership changes. So subdivision, you sit on it for another few years, and then and you find it that also doesn't, the acquisition date is also not reset. So just because you subdivide is not really going to make a new difference. With the cost base, and this is the cost base of the new lot. So you have a block that you've now subdivided, and now you've got this cost base when you're about to then sell it. How do you allocate? And I see frequently you might have a block, and you'll see these are all around the peninsula. Someone buys the house, and they subdivide the piece off the back, and they go to sell the land. So how do you apportion the cost base between that? And it's really, often it'll be based on, either firstly, if it's just land, you might do it on land space, but we always recommend going and getting, whether it be an agent or someone, to come out and value and say, look, whatever you paid for that land, how would you allocate it across the cost base? Because often if there's a house on it and the other piece is vacant, then there will be a different cost to that, and that gives us our cost base to get us ready for whatever it is that you're doing next, whether you're selling them both off, whether you're selling one off, and it's that kind of planning up front. Now, one thing I do want to highlight here, and it goes back a bit to that prior example I just talked about, is partitioning. Now, partitioning is basically subdivision and splitting of ownership. Now, as I mentioned earlier, the subdividing doesn't in itself cause a CGT event, doesn't cause, you haven't sold it. But if there's a change of ownership, it can. Now, I just want to highlight one point, and this bit's outside of my expertise as far as you need a lawyer involved, is partitioning, because there can actually be a situation where you identify a land with your friend and you say, hey, let's go halves in this land as tenants in common, and we're both going to build, townhouses on it, and at the end I'm going to have townhouse A, you're going to have townhouse B. Now, there is such a thing called partitioning, where you actually have a legal agreement that needs to be very, very carefully worded, so that it's clear all along that you owned that front part of the block, and that your friend owned the back part of the block. That was always the intention. And then you did the townhouse development on it. So if you go back to my earlier example, if we were able to, if you had a legal agreement in place that really defined the partitioning aspects of it, you could actually justify that there was no capital gain event, because I just got what I actually was always entitled to, and my friend also got what they were always entitled to. So that's a really, really important one. And we've seen, I mean, Paul, we've seen this one go through audit where people have come after this has all happened. And we've had to go through the situation. But if you can have a legal agreement done up front, you're going to have no questions, in a sense, or challenges from the tax office in going through. We had this situation with a client. We did have to get a lot of documents to try and show that all along the intent was partitioning. So that's one thing that really could, if you are doing something jointly with someone, is being able to show that one as well. So now just going on to then PreCGT Property. So PreCGT Property basically means you purchased it prior to 1985, before capital gains tax existed. What a great time that was. There was no capital gains. You could make as much money as you wanted to on an asset, and you didn't have capital gains tax. So we call it a PreCGT property. So capital gains and losses, they're disregarded on those properties. When you've got, if you do go through a subdivision process, so if you've got a block that you've held for a very, very long time and you now subdivide it, that does not impact your PreCGT status. So it's still pre-capital gains tax. There's no tax payable when you sell it as a vacant block. The partition process, just be aware that with the PreCGT assets, so partition was where you've got this agreement with someone else. If you have a change of ownership, because often if you've held it PreCGT and you've subdivided, that's not going to be an issue. But if you've got it where you've actually subdivided and, you know, a friend is, you've got basically a friend owns half of it afterwards, so it's a different ownership, you will actually trigger capital gains from that point. Now, the one thing that's interesting to note, that you can have a PreCGT, say, block of land that you subdivide, and you can put, say, units or townhouses on it. Those buildings or improvements are now no longer PreCGT. So you don't pay any tax on the value of the land, but now you do pay tax on the value of then the building and the gain that you make on the building at that point. So that's some of it. If that comes up, that's something that, you know, we need to kind of have it well documented, because preserving PreCGT assets, they're just gold now, because there's not many around that people still hold. So we really aim to try and preserve that and get the tax-free part of it. So moving on to the main residence exemption. So the main residence exemption is one, and there's been a lot of developments in this particular area. And the exemption means basically the house that you live in as your main residence, provided you have no other main residence, and it's under 2 hectares, is going to be basically tax-free. So you can sell your house, buy another house, and not actually have capital gains, because it's all for private use. So it's your main residence. But there are going to be some challenges. So, for example, under the subdivided land, so you buy a house, you decide to subdivide the backyard off, and you sell the backyard off. That subdivided backyard piece is not part of main residence, because it's only basically related to your house and very closely related to the link. Now, one thing also that has come up more recently is also in relation to vacant land. And I was researching this when I was putting their slides together, and even found some cases on this where dwellings were demolished just before the sale and it was the main residence, and it was demolished just before the sale and then sold as vacant land, and the ATO denied that that was main residence. They said, no, you didn't sell a house, you actually sold land. So that's one thing that it's really linking with a main residence, linking back to the fact that there's a house on it. So you probably need to leave a little something on it, but it's a house on it. And then newly constructed dwellings, if you've never lived in them, you won't be able to claim those as your main residence, because you never lived in them. Even if the land had your main residence on it forever, now you've demolished it, you've put, say, new townhouses on, but you never lived in them, then it's not main residence. There are some concessions for the construction period, so when you've got overlap in time. And then there are some rules that we need to look at, is that your main residence could reset depending on when the home was first used to produce income, and there's some other rules around that area as well. So that's kind of the capital gains tax side of it. Moving on to the other side, GST. Thanks, Paul.
Thanks, Shannon. Sorry about the slow moving. I was trying to answer questions and do the slides at the same time. That didn't work, so I gave up. So we'll answer questions at the end. So now moving to GST. So just to keep things interesting and make it as complicated as possible, the ATO, we have two different sets of legislation. So the GST is completely different to income tax. In terms of where we get our legislation from. So there's some terminology difference. Fortunately, in this case, we have got a pretty similar connection. So I'll go through that now. Do we need to register for GST? So like any business or any organisation, it's the following on your screen. So are we conducting an enterprise? In that enterprise, are we turning over $75,000 per annum? Then yes, we need to register. If we look at enterprise, the business of property development. So if you're in a business, you are going to be considered to be in an enterprise. The legislation for GST actually considers enterprise to be more broad than what you would normally say as a business. So therefore, it definitely encompasses business, and essentially would also encompass, in most cases, a profit-making undertaking. So basically, if you've concluded that you're going to be on revenue account, then highly likely you're going to be needing to register for GST, or at least be considered an enterprise. In terms of your GST turnover, so you only need to include your GST turnover. So you can take out things like input tax applies, like things like if you've got a separate asset that's on a capital account, or if you've got rental income from a residential property, that's not included in your turnover. But I dare say that if you're selling property, you're probably going to be projecting a turnover higher of $75,000 in a year. So we're probably going to definitely go over that if we're in the enterprise and revenue account state. GST treatment if registered. So most things here are taxable. If we're selling vacant land, that is taxable for GST. If we're selling residential premises, that's input tax. I know there's no GST there, but obviously if it's a new residential premises, then that is taxable for GST. Same for commercial residential premises and commercial property. I touched on the margin scheme before. So the number one thing is, and this is why it's important to get in early and to have all this correct going into the contract, because I'll circle back to the circumstances in which we can use the margin scheme, but the important thing is you need a written agreement, and that is generally in your contract of sale. So you don't want to sell the property, then go to your accountant 10 months later after settlement and go, here, I sold this property, because there's a fair chance it's going to be too late to do anything if something's gone wrong. So that's why we need to get in early, make sure if it is on revenue account, check our eligibility for the margin scheme and make sure we get it right. So circumstances in which we can use the margin scheme. So this is quite a complex and broad area. I'll just go through a few basic ins and outs of whether you're in or out. So they made some changes. When was the changes? Quite a few years ago now. So basically the amendments affect your eligibility to use the margin scheme where the property was purchased by or acquired from inheriting a property, or if you purchased it from an associate, or if there was a GST-free sale in terms of going concern or farmland where the seller was not eligible to use the margin scheme. So basically, if none of those amendments affect your purchase or acquisition, you're eligible to use the margin scheme if you either purchased the property before 1 July 2000 or purchased the property after 1 July 2000, and one of the following applies to the seller that you purchased it from. They were not registered for GST or required to be registered for GST. They sold you an existing residential premises. They sold you the property to you as part of a GST-free going concern or a GST-free farmland and were eligible to use the margin scheme themselves, or if they sold you the property using the margin scheme. So that's probably a lot there. It is quite a complex area, and importantly, you may have picked up that there was a lot of information that we need to know about the seller in that, which is not necessarily something we're going to have easy access to if we're 5-10 years down the track and we weren't related to that seller. So hopefully in most cases you probably fit into one of those examples, but it is definitely something we need to look at. And if you can fit into the margin scheme in your own revenue account, then get that written agreement in place to use the margin scheme. The subdivided land, so the portioning of so on margin scheme, so this is important. So how do we apportion the cost of the subdivided land? And I think Shannon touched on this a little bit. It's basically any reasonable basis is what they're requiring. So again, land area is generally considered a pretty straightforward one, but depending on what you're apportioning, what type of cost you're apportioning, value or something else as well. But generally, land area is pretty straightforward. But again, it's just asking you to rely on any reasonable basis. The GST withholding rules. So the vendor must notify the purchaser of whether they're required to withhold GST. And so if they're required to withhold GST, the purchaser will actually pay the OTO a certain amount, depending on whether you're in the margin scheme or not. So that amount can then be affected on the BAS of the vendor when they then go to lodge their next BAS statement. It can be recouped if there's other items or something in there to match on there. So it's the ATO basically collecting their money up front, and then we can go and lodge our BAS statement and get some back if that's applicable.
And that's probably one thing. Go, Paul. Was that?
No, sorry, I was just about to go. Let's take over.
Yeah. And so that's one probably with that GST that a lot of you, if you've recently purchased property and all of a sudden the conveyancer is asking you 101 questions and telling you you've got to speak to your accountant about the GST, and you're thinking, I'm just purchasing my home, or why does it matter, and why do they need to know if I'm registered for GST and I'm just buying a block of land? These are all the triggers that are actually there, that are basically causing it. This is the tax law behind it, and it's the obligation is generally speaking on the seller on this, and they want to get it right, obviously. So that's why you're getting that a lot from the conveyancer. So now look, there are some other areas and on subdivision as well that I want to go through, and I actually invited Jackie Prosser. So Jackie Prosser is an expert town planner from Prosser Town Planning. There's a lot of tax issues. You need to speak to someone before you go through, such a subdivision or anything in relation to a property. And I've seen firsthand, someone buying a property with the intent to use it for retail, only to find out they actually didn't bother speaking to a town planner before they did that, bought the land, spent 12 months, held the land for that time, paid mortgage on it, went to the town planning at the council, who said, oh yeah, sure, you can do retail there, provided we give you a permit. But as per 3 years ago, Mornington Council said that we would never give a retail permit to that, to that particular block of area. So they ended up having to sell the property. So it really kind of thinking back to that type of example, I wanted to reach out to Jackie and just to give you just a quick summary of, why should you also be, if you're going to be going through a subdivision, what are some of the key things to think about before you start to even, I guess, go through that process. Thank you, Jackie, for coming along.
That's right. Thanks, Shannon. I thought planning was complicated, but clearly accounting is way more complicated than planning. And I'm certainly glad that, you guys are there to answer those questions. But clearly one of the key questions is always about confirming whether a site is subdividable. And that is potentially based on the zone and or the overlays that relate to the property. And you can always ring a planning consultant like myself, or if you're patient, you can also ring council and ask them the questions as to whether a property is subdividable. If you do intend on subdividing a property, I would encourage you to obviously speak to an accountant in terms of how you structure your contract, but also consider securing a long settlement for as long as possible, because we can actually lodge a planning application prior to settlement. You don't need the vendor's consent to lodge a planning application, so you can utilise that time prior to settlement in actually going through the planning application process. It is also beneficial if you are looking at developing a site to actually establish what sort of infrastructure costs you're going to be up for, how far away is the drainage system, is it likely that you're going to have to connect to NBN that's, you know, halfway down the street, just to better understand what the cost implications are going to be for actually undertaking the subdivision works. And as always, like anything, I would strongly encourage you to do your homework and seek input from a range of professionals to establish the timing and the likely issues. Definitely having a discussion with either a planner like myself or a licensed land surveyor is going to be able to give you a lot more guidance on the process, the cost implications, and how you would proceed with your development. And as always, like Shannon, happy to answer any questions in relation to that process if and when you get there. Thanks, Shannon.
Yep. Thanks, Jackie. So we might just go on to questions, but it is something, you know, the one thing about land is, and any developments and subdivision, is you're talking about a lot of money. That's the key, that you are talking about a lot of money involved in the transaction. So getting that kind of advice up front. And I love the one about the long settlement, because I've seen that before with clients where they've had a long settlement and they've actually had the subdivision come through before they even settled. So straight away, they're off the bat and implement.
I actually did it for myself, and by getting a long settlement, prior to settlement, I was actually able to install some infrastructure in the road reserve, getting ready for settlement to occur and the subdivision to occur, because I didn't need access to the site. Clearly there's risks associated with that if the sale had fallen over for whatever reason and you have actually outlaid costs on your site prior to settlement occurring. But you know, if things are secure and you understand the process and the role that you need to go through, then it certainly is, there's benefits in utilising that that settlement process.
It's kind of free money, isn't it, at that point?
Well, there's no holding costs. Yeah, no holding costs. So yeah, you're able to, and the subdivision process is quite drawn out. So you do need approval from council under two different acts, under the Planning and Environment Act, under the Subdivision Act. And the subdivision process involves input from a lot of authorities like United Energy and Southeast Water and Telstra and NBN to actually establish what their requirements are in terms of installing infrastructure to each of the new lots, because each lot has to have access to all the services separately. I mean, most of your clients who are listening have already been through this process, so know this stuff firsthand. But if you're thinking about doing it, it is, there is a fair few steps in the process that you have to go through.
Yeah, great. So we'll turn it over to questions. I've got some questions here, so I'll read these out for you, Paul, because you're the expert in all of this, aren't you?
Pressure's on.
And now, if you do have any other questions, please just put them in the chat or the Q&A down the bottom. So I've got one. If you go into a partnership with another non-family member and have the intention to subdivide, build and sell as quickly as possible, is this the 100% revenue option?
Yeah, I'm thinking that's a profit-making undertaking by the sounds of it, because you're not holding an asset just to hold an asset. You're making your intent from the outset is to make a profit.
Yeah. So I have another one. We have owned our house block for 16 years. In 2019, we built a second house at the back and left the renovated house at the front. We now live in the new house at the back and rent out the old house at the front. We're in the final stages of our subdivision. We plan to keep both houses for a while. Is it correct that we will only pay CGT on the proportion of time that the old house, which was our primary residence before rented, if they sell it in, say, 2022, will they only pay capital gains on the profit from the time they moved out of the house 2020 to 2021?
Wow, I should have been taking notes.
That's an exam question. You've got, basically looking at it, you've got a main residence, you've gone onto the back piece. I would be saying it is most likely that you're only paying capital gains tax on that front piece, but I'd be wanting to put together all of those factors that you had earlier and the whole story, just also the valuation of what it would be at the time that you actually then built, you know, built the new house at the back, what was the land worth at that time? Because I think you'd be wanting to make it really clear on that, because I think that that's the bit that might be the profit. You know, what was your intent on doing it, and what was it?
Well, I feel like that's going to be in the CGT space because everything was long held. So I don't think that's going to be on profit, on revenue account, sorry. But and then obviously there's going to be a fair bit of main residence there, apportioned over the days that you can claim it for the main residence versus when you weren't main resident.
Yeah. So so I'd keep all of the, I guess, all of the information that you've got, and make sure you've got built the story basically, because often if the ATO comes in, it's not going to be, you know, it's not going to be in 2022. It's going to be in 2024, 25. You know, it's going to be a lot longer. Yeah. Okay. Oh, good. They got valuations at the time, so they were prepared. That's good. The person that just wrote that question, they did get the valuation. So you've got those as well. So that's great. It's good to have that because it's that hindsight. There was a question about you're referring to a contract of sale on the subdivision, not the initial purchase of the non-subdivided. Yeah, contract of sale at the subdivision. I think there was a question that came.
I think, yeah, so I think it was, yeah, so it's your intent when you purchase the property, I guess, is considered. But I mean, it's your intent the whole time. So if your intent changes, that can actually change what you're classified as. So you can actually go from a capital asset being on capital accounts, revenue account, and vice versa, depending on your intention. So I guess it's your intention. Your intentions can change, but it is really important. What we found in particular, it depends on, you know, sort of what you're arguing. So in one particular case, we were arguing that their intent was to hold the property long term, but then they sold it pretty quickly. So in that particular case, we had to provide evidence that at the time that they purchased, they had the intention to hold the property and to live in it for an extended period of time. And so that's where we needed to find documents and details to prove that.
Yeah. And it's about building, in a sense, I guess it's building the story and making sure the story is factually correct or can be defended, but it's about building those documents as you go through the process, ideally, so that you're not in a situation 4 years down the track trying to find that type. What was that? How can we prove what our intent was 4 years ago? You know, and in that particular situation, they actually had two different properties that, as Paul said about the history, that particular situation, we had a client that had done had purchased a property, built the townhouse on the back, sold them off, then moved and did it again, and then, you know, and it's that kind of what was the intent overall. And in some situations, it was that they just moved properties to each time get a slightly bigger house, as well as they went along. So it's really about having the story to be able to support it. Yeah. Yeah. Do we have any other questions? I don't have any other questions that have come in. No,
I think that's it.
That's great. Well, I hope you'll love accounting and taxes as much as we do. By the end of it, I think maybe not. I guess some of the key, just one.
I've got one more question by the looks of it.
Yep. Okay. So if you live in the house on the block that you decide to subdivide and sell, but the house is in need of desperate renovation, would it be better to knock it down and sell it as land, or leave the shit house? So currently it's a great house. You'll actually need to leave it, even if it's not really hardly standing, because if you do sell it as land, there will be potentially, what we've seen with just some cases with the ATO is that if it's sold as land, they say, well, that's not your main residence. It needed to have a house on it at the time that it's sold. If the
I think
house
it's got to be, I think in theory it's got to be an inhabitable house as well. Like,
yeah.
It's got to have some running water here and things like that. So.
Yeah. Okay. So yeah, thanks everyone for joining. You want to flip that on, Paul? What have we got?
Oh, yes.
Yeah. Yeah, thanks very much for joining. If you've got any other questions, feel free to reach out to either myself, Paul Cunningham, or Daniel McCulloch in our offices. And happy to help you out. And it's always probably best to have that, have that bit of that chat up front about what you're looking at doing, what's your intent, How can we work with you to make sure that what you're hoping to achieve is consistent with the intent and consistent with the story, that we're going to be able to make sure we have that factual story at the end to be able to defend it and build that case, so that if you do get a question later, we're not going to have, any challenges from the ATO. Because one challenge that you do have when you do capital gains, you are telling them how much money you made up front, and then you're discounting it down. And that's, that can be a bit of a challenge. So thanks very much, everyone, for coming. And we will catch up with you all at the next, next webinar, or hopefully we can have our face-to-face workshops again next year, pending everything going okay with COVID. Thanks very much, everyone.